I think the market's in a good spot. This is a lot like the historic midterm election years, which not a lot happens for the first 9 months, but the average return since 1946 in the fourth quarter after the midterm election is like 7.9%. So I think things are setting up now. We got a great economy. We've had just about the best quarter that's finishing up that I've seen. And so things are good. There's parts of the market, the industrials and, materials, airlines that are really gone down quite a bit. I believe that's where the values are. But the backdrop's good. I'm bullish from here.
Craig, we had a weird comment earlier that I was trying to work my way through, and that is that things are so good right now that they can't get any better. So that was taken to be a bearish signal. And did you hear that, Vic? Did that make sense? Yes, things are so good right now, they can't get any better, so that's time to sell.
This morning, you mean?
Yeah. Does that, I don't know if that, so they're so good, they're as good as they've ever been in history, but they can't get any better, so you better watch out.
You've seen a lot of these companies report unbelievably, like U.S.
So
Steel,
there's nowhere to go but
unbelievable
down.
blowout
Nowhere to go but
earnings.
down. Is that what
and it's like, this is as good as it gets, and the stock's down 20% from the time they reported. So, yeah, there's a lot of that out there.
Do you have targets, Craig, or you don't use targets typically for the S&P?
No, but yeah, the S&P has never declined in the 12 months following a midterm election since 1946. So the market does have some considerable upside, I believe, from here.
All right, Victoria, you heard some of Craig's comments there. Do you more bullish, less bullish? Where do you fit in on the grand scheme of things?
No, I agree that we have some more room to run. I mean, if you look, yes, he's right. The economy has been really strong. The last 2 quarters on earnings have been great. We're really looking at 2 major things to keep pushing this economy forward, and that's going to be CapEx, one coming in. That is key, we think, because one, it has more goods producing jobs, you bring more people into the labor market, and it increases productivity. We saw the productivity number go higher last week. And you have those 2 things come together, that's your potential GDP moving higher. So we think there's a huge push from CapEx, and the consumer has been incredibly strong. Yes, we saw it in the second quarter numbers, especially the retail numbers over the last couple weeks, but we also saw retail sales, the control group, up about 0.5% last week. That's at the high end of their 6-year range. So we're really laying a strong foundation for the third quarter for the retail, and then you go into the holiday season, which is usually strong for them as well. So I think we have some strong headwinds behind us to keep this momentum moving forward.
We've also been hearing that and the Fed's on everybody's, we're all talking about that they've never orchestrated really a clean break, especially, and they've never had this much, they've never been this much involved in the economy for such a long period of time before. I mean, do we know that they're going to be able to exit smoothly, Victoria?
I don't think we know for sure that it's going to be smooth, but I think they have a good path laid out. I mean, we anticipate we'll have 2 more hikes this year. September is basically priced in. December is about 65-68% priced in at this point, 70 kind of being that line in the sand. And then you have a break until you get closer to June. We actually heard Kaplan yesterday in his interview with Steve say he anticipated 3 to 4 more rate hikes over the next year. I think that's pretty much what the market has priced in, and so there shouldn't be any big shocks unless we hear something or have some geopolitical events that really move the market. I think we can somewhat go along the path that's been laid out, and there shouldn't be too much of a market movement based on expectations.
I mean, I'm usually comfortable thinking that a lot of people say that, they've already put to bed or put it to rest that the Fed orchestrated a great response to the financial crisis and that we're in the clear and that we're out of the woods. And I started believing that as well, Craig. Can it still come back to haunt us, in your view, at this point?
I don't see it. We at Hodges Capital, we make about 3,000 company touches a year with our analysts and over about 850 companies. And I've never heard a more optimistic, bullish time than we're hearing right now. There's a lot of people think we're in peak earnings, and even if we are at peak earnings, and let's say the yield curve inverts, you still have on average about 18 months of positive market that'll go up 21% from the time that the yield curve inverts. And so I don't see, there's still pessimism, there's still skepticism out there, and that's what you need for this to continue.